Let's talk more about the economic outlook. David Doyle is a North American economist and Canadian market strategist with Macquarie. And David joins us this morning with a little bit more on what he's been watching for. And David, in that story, you really get the sense that there's this big question around the bills going forward, but the challenges we are facing today.
Yeah, I think that, I think the response was maybe the easier thing to decide for the government, in the sense that it was quite justifiable to need to come in and provide support and provide a floor on activity as we've gone through the shutdown period. I think moving forward, it's going to be a much more challenging question, which is how do you, start to unwind some of this support, given the very elevated deficits we're likely to see, even as activity hasn't necessarily fully normalized, across the entire economy.
What do you think? Got any ideas? Got any solutions, David?
Yeah, I don't think that there's any easy answers. I think we're between the governments are between a rock and a hard place, and I think there's a strong argument to be made, at least so far, that running these elevated deficits have been the lesser of two evils. Our projections suggest, for example, the federal deficit could be as high as 20% in the current year. I think as you move forward, Canada's growth is likely to be pretty subdued, and there's a few reasons for that. Most significantly, it's the structural imbalances that we have, the elevated debt levels, and particularly in the private sector amongst consumers and non-financial corporates that are quite elevated and have run up over the last decade. That, I think, will act as a constraint on growth. And then you look at what's driven the economy over the last decade, and it's really been the energy sector and housing as well. And I think it's going to be tough to necessarily rely on those same sources of growth going forward. So as we turn the calendar to, say, 2021 or 2022, I see a real absence of growth drivers, and I think that could lead Canada's economy to continue to underperform as it has in recent years. And that, of course, might mean that these elevated deficits, which at the present moment, a lot of people are calling more cyclical deficits, there might be a component of them that turns into a more structural deficit, and that could, put our government's financing under pressure.
So that leads me into another story we've been talking about this morning, which is we learned from S&P Global Ratings that British Columbia's top investment grade rating was put on negative outlook. This is just one provincial story, but how's that going to unfold? Because I get the sense that at the very least, the credit rating agencies are going to give a heads up to provinces and certainly the country overall if there's going to be a meaningful change to their ratings. But I suppose that just would add another complication to things if we've got to go out and borrow around the world to pay for all of this.
Yeah, look, I think, for a couple of comments on that. First is that, BC has, actually had one of the strongest finances amongst the provinces. And, it sort of was entering this COVID-19 shutdown period, projecting to run a little bit of a surplus. It's also had, I think, one of the better health outcomes. So it's been less significantly impacted from a health perspective by COVID-19 than the other provinces. So I think that might be telling you something, that if BC has its outlook downgraded, some of the other provinces might follow from that. Personally, look, the markets will react sometimes in knee-jerk fashion to credit outlook downgrades or even an actual change in the credit rating. But to me, it's more the signal that it's sending and what it's telling you about the underlying economic dynamics here. That's more important. So what it's telling you is that there's slow growth. There's a lack of growth drivers going forward, and that these deficits that we're running today, there might be a persistent component to them in the years ahead.
David, you're one of the few people we can talk to who wears, this stock market hat and this economist hat, and we're sitting here and we're having this conversation. And I know markets are under a little pressure this week, but we've seen this huge bounce off the lows. Maybe you can explain that disconnect to anyone who's wondering, hearing what you're saying, which is a little alarming, a little concerning, but the fact that investors have been piling into a lot of stocks recently.
Yeah, I think that there's I can see that you can see that in the major indices. Certainly, if you look at just the aggregate index, there's been a big bounce. But if you look below at the sector level, I think what you see is a very, very different picture. So you see things like tech stocks, roaring and ripping, and particularly in Canada, I think that's relevant to the extent that the tech sector in Canada receives roughly 90% of its revenues from abroad. So that's less of a play on what's going on in Canada and more of a play on what might be going on in some other economies. If you look at sort of the sectors like financials, they're continuing to struggle. They haven't bounced that much off the low, so I don't think they're discounting the same thing. I think that's an important nuance to be thinking about and is relevant, particularly in the Canadian market. And the second thing I would add to that is that the intervention has just been extreme on the part of policymakers, particularly central banks moving with QE programs. The Bank of Canada's balance sheet tripled or even increased more than that over the past number of weeks. And I think that that's helping to provide some broader support to asset markets as well.
Helpful context, David, and a lot more to watch, so we'll be checking in with you again soon. That's David Doyle joining us, North American economist and chief market strategist at Macquarie.